Yeah, so for founders who may not know your firm yet, can you give us a quick overview of your fund, what you focus on, the type of companies you back, and the typical stage and check sizes you typically invest at?
Great. Yeah. Thanks, Sammy, for having me here. So G2C Ventures, we call grit to capital, founders grit, and we bring the capital. And in early stage fund, focus in enterprise AI. That means we write 300 to 500K checks in companies that are primarily automating business operation. They're not necessarily assisting, they're actually helping automate something within a enterprise. We don't do consumer, we don't do hardware, but we're very focused on enterprise software. We are founders first because we have built things ourselves. We've gotten rejected. We have scaled companies to millions. We have personal investments that have scaled to billions. So we have understood how to build company from scratch. So we don't just wire money and ghost founders and show up on board meeting, directly helping them along the way. Because the truth is, even today, 86% of seed funded companies will fail. So, and why is that the case? Even though a founder who quit their job, sacrificed their family life, and are actually running a company, somebody wrote a check for them, means somebody did some due diligence and made sure it makes sense. But even then, only 14% survive because the game is changing fast and you need to learn that game. And we help coach founders to how to play the game. You got to see the whole thing from start to finish, and we help them go through that journey.
Sure, I appreciate that. And I want to get your perspective and insight. As a managing partner, what do you think separates founders who successfully raise venture capital from those who struggle to get any investor traction?
So for me personally, and for our fund, evidence before ask means, just vision and vibes and cool pitch doesn't make sense anymore. Because, thanks to ChatGPT, everybody can write a great pitch deck. But the barrier is really, have you found somebody who's willing to use your product? Have you actually found a real pain point? So a lot of founders start with solution, and first 3-4 slides is all about how great the solution is. I'm looking for founders generally who have discussed the problem. They have either understood the problem because they have lived it, they work in that industry, or they have researched it so well enough that they've gotten somebody else to say yes to their idea. Not just me who will write the check, but somebody who will actually use it. So that's the number one thing that we look for founder who raise. Founders, who struggle, they're trying to say all the right things, but we can figure out within the first 5 minutes of conversation that have they lived it or they just know how to talk about it. The other thing I would also say is, the barrier to entry of creating a startup, especially a software startup today, has gone down 10x between last year and this year. What I mean by that is, it's so easy to start a company today because of all of the AI tools that are available to you if you need to use them wisely, including writing the code for you, pushing the code to production for you, even selling it on your behalf if you get the right agent working for you. So the barrier is no longer about thinking about a solution, but thinking about the problem. So founders who come in, walk in the door, start talking about problems, how they're going to fix it, what they're going to do, are the ones who actually raise fairly quickly. And that's what we're seeing in the data as well from Carta and others.
Okay, appreciate the answer. And that was answered so well, you kind of actually touched into the next question I was going to ask. So you can add a bit more detail to what you were saying. But in terms of just the contemporary startup world, which you've slightly addressed there, what major shifts are you actually seeing in venture capital right now that founders should understand?
Oh, as I said, it's 10x easier to create a company. That means there are that many more founders in the market. It used to be that people who were creating software company would come from about 60 million people who actually know how to code. But today you can create a company even if you don't know how to code. So that is a major shift. This is also leading to companies growing much faster. There are 4 companies I would name, Lovable from Sweden, Cursor from United States, Emergence, which started originated in India and now based in the United States, and Base 44, acquired by Google. All of these companies created 100 million ARR business in under 12 months. And nothing bad about the founders, but they don't have the pedigree typically that you will look for a founder, that they come from a very specific background or very specific university, or they were, born with a silver spoon in their mouth. None of that. These founders knew how to iterate fast. So that's really what's changing, because the cost of developing software is going down. And these companies specifically made it go down even more. So that's number 1 shift. Number 2 shift is the product market fit, how long it takes for founders to find the product market fit. That has shifted. If you're around with a problem today and it's been 12, 18 months and you haven't really found product market fit, as in customers who are willing to pay for your product, VCs can't fund you anymore, because there are other folks who are finding product market fit in 6 months because they're iterating faster. So that's the second big shift we are saying in change. And the last thing I would say is founders, who are able to understand that it's no longer a top-down selling model where I have to go sell to the CIO or the CFO directly. Founders can today start selling to one person in a company on their personal credit card, and then sell it into their team, 3 people in a company or 3 people in a team, and the team sells it to their department, the department sells it to that. Now, in the old way of doing things, the sales cycles were 12, 18 months, but look at the size and growth of some of the companies I mentioned earlier. They're growing at 100 million ARR. You can't hire salespeople fast enough to sell that. That means they're using this prosumer model. They sell to one professional consumer who sells to their peers, who sells to their team, who sells to their department, and hence the procurement. And that model is actually working fairly well. So these are the shifts that founders can actually leverage to grow fast. And I hope some of the ones that are listening and some of the ones that you work with, Demi, can utilize some of these strategies on how they grow.
Really good advice. Like the examples you've given as well, some of the kind of recent exits and success founders have found within such a short time period. Now, let me ask you this then, especially from kind of G2C's perspective. How do you determine a startup's value?
Oh, that's a great question, because founders, I think some founders obsess over it too much. And I generally stay away from those founders, mostly because, at this point of starting a company, valuation should be important, but can't be the top 3 priorities of a founder. Mostly when we are valuing a company, we're mostly valuing the founder and what their vision is and what their grid is. Can they build a $1 billion business? Are they trying to say the thing they have learned on internet, or do they actually have, personal, unique thoughts in how they want to run the business, not just build the business? I have founders who come in and they say, I'm going to definitely build a $1 billion company. And they sound a little crazy. And actually, we like that. We actually like those kind of founders. But really, their spreadsheets and their financial models at seed stage really don't mean a whole lot, because very soon I go after the assumptions behind the models, and their assumptions kind of fail out. So their spreadsheet may have a perfect Excel macro calculating the valuation will be, $100 million without any revenue. That kind of doesn't really lend itself to their credibility. So the bar for us is, do you own the problem? Do you understand the problem? We value the company automatically high. We look for, do you have relationships that somebody just cannot buy, right? You have special access to either a company or an advisor to understand that problem even deeper. Have you lived the pain? So all of those things we look at valuing the company. Because the bar has, as I said, the bar of building something has been really lowered. Means anyone today who speaks English can build a software program. This wasn't true 10 months ago, but this is true today. And it may not be something that's the most scalable, at least they can get a prototype. So a founder who walks in with a prototype, with a problem, and, oh, hey, I have already XYZ used my product. They're not fully paying for it, but at least they're using it. They're giving me feedback. We value that founder super high. And of course, we want them to have a good team along with them. We do believe in a founder that has to have a mental capacity to work with a team. We don't see this single person, billion-dollar startup quite successful yet. I think it's still a team effort. And in that context, we want a good valuation of a company so they can hire more team. Hey, I raised, $5 million at 20 million valuation or 25 million valuation, and then people get excited to join that company. So we really want to give them a good valuation, but they need to bring in some of the things. And this is kind of the previous question you were asking, who raise and who struggle. The ones who raise, they prove all of these things when they come into the room. The ones who are struggling is saying, hey, I'm on a $50 million valuation. I have nothing to show for it yet, but believe me, and I don't even have a customer who's using it yet. And I've been around in the market for 18 months shopping for an investor. I think those are the folks we kind of have to say, maybe next round, but not right now.
Okay, I appreciate that. And you went into quite a lot of detail from a qualitative standpoint, that you're looking at the founders and you're looking at the team. And just to kind of clarify, from a metric standpoint, we're talking quantitative. You're not focusing too much on that at this stage?
Not at the seed stage. We mostly invest in pre-seed and seed stage startups. So these are founders who are really have a great idea. At this time, their metrics are really going to change within 3 months of the companies, no matter what they put in front of me. What I do want to understand is, do they know how to build a model? So how they will scale from 3 customers to 10 to 50 to 100 and so on. So, some level of spreadsheet expertise is good, but we're really not at a point where I can use a financial model. It's more of a personal model, their personal struggles in the space that they're working in, their contacts, and how much prototyping did they come in before they walked in, would tell us, where can they take it. So I'm more focused on that. Look, the valuation of an AI startup is a lot higher than a SaaS startup, because typically a SaaS startup or a SaaS company has around 600 to 800,000 revenue per employee. Whereas an AI startup today is somewhere around $2 to $3 million revenue per employee. So they're already coming in at a little bit of a higher valuation because they can grow faster with less number of people. We want that growth to happen, but the time at which we meet them, generally we're the first check-in, they really barely have any revenue. So putting a lot of focus on the financial metrics is not how we do things, at least at G2C Ventures.
Yeah. Okay, for sure. And then in that case, what does due diligence look like for you then? If you're not focusing too much on the metrics, you're looking more at the founders and the teams. What are your expectations when you get to do the due diligence with the startup? What are you looking at there?
I think that's a great question, because when we meet a lot of founders, and I would say 80% of them, they have not gotten a lot of market traction, but they're expecting, again, a check to be written to them for a fairly high valuation without any traction. So I would say, if our founders listening to this, build some traction before you reach out, because that's really number one part of our due diligence is, can I pick up the phone and call your user? They may not be writing you a check, as to understand why they're using your product and or your solution. It could be even a service, why they're doing it, as well as what other alternatives they're concerned. So those are kind of things that I would typically want to know. I also want to know for them is how they think, if they're using it, what do the peers say about it, right? The same playbook of having a prosumer use your product, sell it to their team, and then let the team sell it to the department and so on. So is that even a playbook possible? They say, no, I'm the only person who uses it, those kind of things. That tells us things. The other thing we look for is a little bit of founder grit, right? That comes mostly through osmosis of discussions like this. It's not a, hey, here's the 5 questions, you answer it, you have grits or not. I mean, it's something that you either do or you don't, right? I can learn Python, or I can learn cooking on YouTube, but I can't learn grit on YouTube. I either have it, it is forged in me as my character, or I don't. That means, every startup that we fund, we know is going to go through 2 or 3 near-death experiences. It's a given. And the founder, we feel like, who's going to get through all of that and probably grind through their life 5 to 7 years, is the one we want to back. And that's something you can get through meeting them face to face, going on a walk, going on a hike, maybe doing an event with them or something like that. But that's really how our due diligence process works, is really getting to know the founder. And then the third thing we look for is, do they know anything about the domain, the space, or they're just saying, hey, I read about this. I think it'd be so cool if salespeople started using this, or mining industry, instead of doing X, instead start doing Y. And like, how much time have you spent in the mining business? Well, I know somebody who knows somebody who knows somebody. It's like 3 levels of association away. But like, this founder is so out of their depth, yet they're so excited about the problem space. I mean, most of the founders that I mentioned earlier who've done the 100 million ARR type businesses, these are people who were developers themselves. They could iterate their problems within their teams fast to come to a solution. They were not like carpenters suddenly started doing this. They knew something like coding. They may not have been most successful coders in the world, but they knew the challenges of a coder. And so they fixed that. I think that's the other part of due diligence, is, do they know the problem space well, or they just read it up online and they think it'd be a cool idea? Because those are the 3, probably the top things we do. And then we get into the financial numbers and so on.
Okay, I appreciate that. That was a very comprehensive answer. It's a good understanding of what you guys are looking at. And on that note, then, founders that now know this, what would actually make you respond to a founder's outreach? What prompts you to kind of want to take that first meeting?
I get this asked a fair bit in other settings as well. Be very honest with you, a warm intro is the fastest path. Warm intro is, if I know Demi and Demi's already met you and they think they will fit our profile, Demi and I speak about it. So a warm intro from somebody we know probably is the fastest path. And that's the honest truth. And we also feel like, if a founder can't find us and get a warm intro, how are they going to get a warm intro to their customers who they don't even know, right? If they want to sell into a Procter & Gamble or Coca-Cola or United Airlines, how are they going to get a warm intro? Because in some cases we can help, but in other cases they have to have the grind, the struggle, the hustle to be able to do it. So warm intro is really important. But if not, cold intro works only if it is done right. We get somewhere between 40 to 100 emails, depending on the week, of cold emails about, hey, I have a sales pitch, would you read to it? And I would say 99% of them, they smell like, one too many. Like, they emailed to 200 folks. They didn't even read our website. They didn't understand who we fund, what we fund. They didn't use any examples of our thesis, or, so they didn't really personalize any email. The generic emails, you would, as you would expect, we would not even read them. But if somebody writes a thoughtful email, we look through everything that comes through our inbox. So we're founders run funds. So we're not just outsourcing it to some AI or some analyst. We actually look at everything that comes through. But maybe we pick up maybe 1% of those. And the ones that when we're picking up are the one where they have actually really reached out to us. And the last thing I would say is, just one email is not enough. Be persistent without being annoying, because that's what's going to happen to you to get your customer also. So some folks, in fact, somebody sent me an email and then somehow found me on WhatsApp and sent me a WhatsApp message just like an hour ago, saying, hey, you haven't responded to my email. I hope okay. I see that persistence. I told them I'm going to get back to them in 48 hours. So we're definitely looking for some persistence in addition to being consistent with how we, with our thesis.
Okay, I appreciate that. That's a very persistent email than WhatsApp, maybe a LinkedIn DM as well.
Yeah.
That's a very persistent. Okay. And from, in your opinion, I want you to take this question however you want to take it. What do you think are the three biggest mistakes that founders make when raising capital? And this can be in regards to anything.
You know, I mean, I want to say it in a way that it helps the founders, not to discourage them about raising capital, but I want to say it in the way to encourage them, right? If you know the don'ts, then make sure you follow through the do. So, as I said earlier, one of the biggest signals we see is founders are pitching before they have signal from the market that the problem is worth solving. That's number one, right? So what I mean by that is a lot of times, the people will be talking about all of the solutions, but when I ask them the traction, they don't have the traction. So I would say it's the wrong time to pitch. If you don't have the traction, then the right thing to do is go and get some traction. Focus on few users, like in our case, corporate users, enterprise users, to use it, give you feedback, and say, this is what we did. We did a pilot with XYZ, and they did not buy our product, but this is what they told us, and this is what we're doing in next iteration, and they're happy to have us come back. Things like that would tell us that you prepared before you're pitching. The other thing I see is a lot of time founders are pitching us, but they just haven't even read that we only do enterprise software. So they're pitching us consumer software or some social media app, dating apps, or somebody's customized hardware for a very specific medical use case. We don't necessarily fund that. That's not part of our investment thesis. So do your homework. It's very simple. The last thing I would say is 95% of the founders only show up when they need money. There's like a old saying in the countryside, right? You can't harvest the season you haven't planted in. So you got to put the seeds of your startup in an investor like me's mind at least 6-9 months before, 3 months before at a minimum, because nobody walks into our office and we write them a check unless we have known them. So get to know us, reach out to us, socialize. Like you mentioned, you come into Bay Area, you like to get together. I mean, do those kinds of things, but do it in a very persistent, respectful way. If we get to know you, there's a not highly chance that we will invest. Even if you are the smartest person in the room and you just come in telling us all the right things, it's going to take us some time to get to know you, because that's what really we are vouching for in our due diligence. So start early, start building that relationships right now, even though you may be ready 3, 6, 9 months out. I think that's probably one of the biggest things I would tell founders is don't make that mistake of just showing up when you need money. Start thinking about who would be the right people for you to talk to and make the relationship early. Plant the seeds now and then harvest in 6, 9 months. I mean, that's sort of the way the world works. And it's no different for venture.
I like that. I appreciate that. I appreciate you taking the angle as well, trying to kind of not just outline the mistakes, but actually tell them something that they can do proactively. That's a really good approach to raising capital. I always say to founders that we work with, treat it like a CRM. Even if an investor says no, keep them in kind of like a loop of what you're doing, have some follow-up cadence and build that relationship. Even if they say no, they can always come back another round. But yeah, Vik, we have this segment called Please Stop, Please Start. Essentially here, I want you to tell me something you want startup founders to please stop doing, and then something you want them to please start doing, right? And it can be in regards to anything, valuation, due diligence, outreach, anything. And the two answers don't actually have to be related to each other.
What should they start doing?
Yeah, so one thing that you think that a founder should please stop doing, something you want them to please stop doing, and one thing you want them to please start doing.
I would say stop just reaching out to investors if you do not have traction. Most investors will say, interesting, we love you, and so on. Meet me next quarter. What they're really saying to you is go get traction. So I'm telling you head on, straight first, get traction. Get somebody else to validate your problem space, not your solution, just that the problem is real. And my mantra is that you should definitely get 100 people to do that. The first 10 are you going to be your friends. The next 20 are going to be acquaintances. They're not going to tell you necessarily the truth on your face that this problem is too small. Nobody cares, things like that. By the time you get into strangers, they're going to say, I have no idea about this problem. So then you're going to start going to industry specific people. Maybe you're talking banking, maybe you're thinking something in mining. I don't know what your focus is. And they start telling you this problem, how big it is. By the time you're 70th and 80th, you have a better elevator pitch, because people don't want to hear you as a stranger for 15 minutes just to tell you what the problem is. They're just going to tell you on your face, sorry, I don't have the time. Not your friends, but at least the strangers would do that. So by the time 70th and 80th, you have a very elevator pitch. So come to us around that time. Spend that effort. It is worth it. If you have the grits to take rejections, that's the number one thing, then you can do it. Anybody can do it. So start doing that, and just stop wasting time on raising money or anything like that unless you have traction, would be my biggest thing.
Okay, and then please, something you want them to please start doing.
Yeah, so one would be, of course, go out and get traction. The second thing is start building relationships with investors early. And the third thing I would say is the tools that are available to you today. There's so many websites, you can look them online, from the Claude and Anthropics of the world to Databricks and others. We actually host events right here in Palo Alto in our office. There are many platforms that can help you get to your customer faster, build your product faster. Today, it's not just about the product. Anybody can build, and I'm not kidding you. Anybody can code today. English is the new language to code. If you know English, you can create a product. The issue is going to be, can I create a product for the right problem? And then how do I get to my customer? And so the problem you own, problem you should own, and then use all of these tools that are available for you to just get it faster. Because one of the biggest trends, I think you asked a question earlier, is the product market fit. It used to take 12, 18, 24 months to find product market fit. Now companies, if they can't find it in 6 to 12 months, they're dead. So you want to be the one who can find the product faster. So use these tools to iterate your solution faster. Find a real problem, iterate faster is what the do's you have.
Vik, thank you so much. I appreciate you so much. That was a great set of answers for the questions.